Hey, Mr. Bill, welcome to our podcast. Thanks for coming by.
It's good to be here, Fabio. It's been a while.
I know, it's been a while. Everything's okay?
Everything's wonderful. Life is great.
You know, we met back in the day when we moved here in 1996, and my mom, Regina, went to work for Vinny Romero back then.
I remember it very well.
Yeah.
And I do remember too that you all were going through the immigration process.
Yes.
And I do remember, and I believe it involved you. You were kind of stuck over there, and we got John Bro involved in it.
Yes, I remember that.
Sent a letter to him and
yes.
Made sure that they got you back over here. The rest is history. You
that was
rewritten the fame of mortgage lenders here in Lafayette and Acadiana.
That's true. That's how I got in the mortgage business. Since you became a realtor with you guys in '96, I graduated from college in 2001, and I wanted to be a financial planner back then. And it wasn't a good time to be a financial planner with the dot-com buzz. And my mom was like, I was in business to a loan officer, Keith DeLotte was her loan officer back in the day at Home Mortgage, right? Home Mortgage,
right?
Back
exactly.
in the day. Yeah. And she said, he does pretty well. You need to look into it. So I started looking it up to see what a mortgage is. And since 2001, and I got stuck in the mortgage business, never left. So it's been a wild ride.
Well, yeah. Once the real estate or mortgage business gets in your veins, it gets hard to find something better.
Exactly. It's been a good ride. But thanks for coming by. And I know you have some insight for us with the information on the market. I love sharing that information. You've been a wealth of information for Acadiana in general with that information, and with the changes in interest rates and the demand and high costs and everything that's going on. I wanted to pick your brain and see what's going on and what's about to happen. If you can tell us, looking back and then trying to look forward a little bit.
Well, giving a little groundwork before I get into the numbers of why I do that, and I've been following what I would call the overall market for probably close to 50 years. In detail, it's been 40 plus years in the Acadiana area, and what I wanted to do is as different economic factors occurred in our country that impacted real estate, like in the 1990s, like in the 2000s when we had the Great Recession. I kind of felt that there was an attempt, and there still is today, of national prognosticators to ultimately use real estate as a national topic. So if I put on the TV to some financial channel today, I'm likely to hear about certainly mortgage interest rates, because that impacts everybody everywhere, but the fact that on average the sales price of a home in the United States last year, for example, was up 6%. And if you hear that on TV, you immediately translate that to have some relevance to what's going on in your market. And in nine cases out of 10, it doesn't. Because real estate isn't a national product, it's a local product. And so I found that there's more validity in having to combat this national numbers jumbo, local information about what's happening in the overall marketplace. Now the real estate practitioners, the typical real estate agent and agencies, they are masters of what's going on at your curb. Like, you call them up, they can go out and give you sales numbers to compare to your particular property and help you price it. What I found there was a gap in is what's happening at the 5,000 foot level. Like, how many sales are going on? What price points are they happening at? Where are those sales happening? What's the fluctuation? How many properties are coming on the market? How's the balance between supply and demand? Those are all things that are valid to know while you're pricing your property. You ought to also know what's going on in the marketplace, and they're not too many people that are crazy enough to be interested in doing that. So I found myself kind of a lone wolf compiling these numbers that made me somewhat knowledgeable about what the marketplace is. And rather than use that because of where I was in the stage of my life, the latter past few years, I've basically retired. I'm not in competition with any of my people who are in the business, so I give away the knowledge. I acquire it for my own satisfaction, and for the most part, of giving the knowledge away. So that's why I do what I do, and that's why I find the information valid. And so let's start digging into those numbers. As we all know, in 2018, we had the COVID outbreak. In 2019, you all may recall, that is when in the first half of 2019, we had the shut-in. That is, everybody who wasn't a designated special type of provider of service, you were not to go to work. And everybody was banished to the homes, and all the kids went home. And that happened during the first half of 2019. We didn't see real estate sales begin to really move up until the second half of 2019. Now, while the shut-in was occurring, people still didn't know how to deal with the disease, and we didn't have buyers that really wanted to go look at properties. Yeah. And we didn't have sellers who really wanted people tramping through their house that were total strangers. But by mid-year, I think people have gotten either crazy enough by being locked into their houses, or they felt comfortable enough that we began to start seeing the next psychosis take over in the COVID, and that is I've been locked up in my house now for 6 months with my kids and my wife, and now I want a bigger house, or I need a place where I can have my own office and not be sharing a home office with my wife or my husband. So that spurred things on, and then you had the Fed, which you're much more closely associated with, manipulating interest rates down to a level where in January of 2021, we had the lowest interest rate ever on a 30-year mortgage. Right. Not ever in the last 10 years, ever in ever.
Ever in
You're
the
going
history of
back
the
to
planet.
the 1930s when we first introduced through FHA longer-term amortizations. This is the lowest interest rates ever were. And that spurred a demand that we'd never seen before. And in the space of 3 years, from basically 2020 through 2022, we saw enormous increases in sales. Now, what happened in 2023 and actually late 2022 is interest rates started going up, and that began to curb sales. And so where we saw basically a 30% rise from 2019 through 2022, or through 2021, excuse me, in 2022 and 2023, we started giving it all back. And I think people, even when we were in the thick of things in 2020 and 2021, even when we were in the thick of things, people knew this was not a normal time. This was a special time. And so either it drove you to want to go out and buy a new home, or for many, it drove them at least to go to see a mortgage company and refinance whatever debt they had. And in some cases, if you had no debt, maybe even to pull some equity out of your home because you knew, and the American people aren't dumb. They knew that when you're looking at 2.6% interest rates, that this is something that was an anomaly.
Yeah, it was a special time, and
very special.
When I did the math on the payments, people were just shocked, because we were able to lock some people. We talked about it the other day at 1.875 on a 15-year fixed mortgage.
Just
so
phenomenal.
It's phenomenal, and it's very is not the normal, right? We were talking about it yesterday. What is the normal rate?
So the reality is that this time, this volatility of interest rates is something we have never seen before, and that is why I think you've seen the shock to the system of what's happened. It's not because the rate of where it is where it is relative to where it was. Correct. And how quickly that happened. And in that same period of time, Fabio, we had such an increase in demand relative to supply that our average sales price went bonkers along with it. And you heard all the stories about just 2 or 3 years ago where you would have a house come on the market and you wouldn't just have multiple offers. People were bidding above what the sellers were asking. Now, I'm not saying that's necessarily gone totally away, because we still have a marketplace where there is some lack of supply, significant lack of supply in certain areas. So it's not going away, but we don't have that same environment anymore. But we've had pressure on pricing, and that has impacted ultimately the affordability. When you combine that with the swing that we've had in interest rates, and another topic that we may touch on during the time that we're here, and that's the cost and availability of insurance. When you lump all those together, one would expect that you're going to have some correction in the marketplace, and that's exactly what started happening in 2022, 2023 more. And here we are in 2024. In the last 2 years, we've given back all of the additional demand that we gave during the run-up of COVID. And so we're back to demand levels at 2018, and we've had increasing supply that's occurring. So how I like to describe it is I believe our marketplace is moving into a more stable type of scenario where we have a fairly adequate supply of selection, which keeps pressure from prices going up too rapidly, and the demand is still there, but it's at a much lower level. It's back to the 2018 levels that we had at that time, pre-COVID.
Yeah, I had a few clients, they pre-approved in January, and the payment, let's say it was $2,000, so they come back to me in June when the rates went up, and the payment was $700 more, and they're like, "What happened to the payment? The house is the same price." And I said, I don't know if you've been watching the news, but you know what happened to the rates? And then I showed them the difference in a regular house. So they went from qualifying for a mortgage to not qualifying for a mortgage, because when I added the $700 payment, and now they're over the debt-to-income ratio.
Absolutely.
And that's happening across the board because the income is not going up, right, compared to what's going on in the price of real estate.
And that's one way of certainly looking at the impact. That is, it's going to cost you X amount of dollars to do this deal versus what it was going to be based on the interest rate. Yeah. But the other way to look at it is, what's the maximum that I qualify for? And so if the payment that you had before at, let's say, 3% was your maximum payment on a $300,000 loan, let's say, whatever the interest rate would be. Now the interest rate is I have a $600 increase or whatever in payment, but that's not the more important thing. You can't borrow $300,000 anymore. Now you can only borrow $200,000, and that's where the affordability factor is hitting buyers right in where it hurts, in the pocketbook. Yeah. But like I'm saying, there's still surprisingly a demand factor that's out there. People are still buying houses. And surprisingly, when you look at January and February's numbers, it's a surprising strength of demand. What is changed is what they can buy. And so what we are seeing is an actual beginning, a little decline in the average sales price, but there is pressure that's moving that downward. And we believe part of that pressure is ultimately the fact that if your rates go up, what you could afford yesterday, you can't afford today, at least not at that same price.
Right, yeah. Yeah, I think also a factor is people that have the 2s and the 3%, they're not selling their house, right? So they're holding on to that mortgage payment because they've seen what else is out there.
Yeah, they are, and you're right about that. But we're beginning to see that chip away a little bit, and I think that's the real conundrum from a seller standpoint. But you're absolutely right. If I'm a seller, and let's say I bought a property just 2 or 3 years ago, then I'm probably have a high leverage relative to value. That is, I may have some equity that I've enjoyed because of the run up in values, but it's not quite as big as it might be because I'm, again, fairly high leverage. To that particular seller, making the decision to move up in value and increase their loan amount and add to that the increased interest rate, then financially it may not make sense to them. But if I bought my house, let's say 10 years ago, okay, then the equity that has grown over that 10-year period of time may well outweigh whatever loss you're going to have relative to, even if you'd refinanced and gotten that lower rate, may well be below what you could ultimately make up in using your equity. And what helps the seller to make that decision is the fear that that average sales price may in fact be declining. And we've seen it begin to do that in 2023. We are predicting that that trend is going to continue as supply increases and affordability does not increase through lower interest rates or any other factor, that is going to have to come through pricing. And so sellers are going to be more motivated, we believe, to think in terms of making that move the longer the time distance is from the event that caused them to say, well, I need to lock myself in with my golden handcuffs into what I've got right now.
Yeah, we saw a pretty good decrease in interest rates in December, January, February, and now back to increase a little bit. So there was a little dip from, we're quoting as high as 8.5%, and then it went down to 6.5%, the best possible rates. Now it's coming up a little bit. So I think, from my perspective on the financing end of it, people, with the normal rates in the 5s or even in the 6, low 6s.
Right.
Very few people don't purchase a house in that rate environment. But when I tell them that the rate's 7.5%, 8%, 8.5%, that's a huge shocker. First, a lot of people cannot afford that. But then to make that financial decision, they're like, hang on a second, maybe that's not the right time, right?
Right.
And you have people that are moving, getting transfer, getting divorced, or having twins, and those guys are going to have to move, right? They have to buy a house. Or like you said, the people that have enough equity, or they live in a house for a long time, or they paid off their mortgage already, and now their kids are going to college, they need a smaller house. So there's always going to be some demand there, but until the numbers make sense, that's when the biggest chunk of the pie is going to come back in the market.
You're absolutely right. And again, a lot of that deals with the distance or time from when the event is. And the example that I use when we talk about this is the flood that we had in Lafayette area in 2016. That became the focal issue for buying property over the next 2 to 3 years. Everybody was concerned. Did it flood? Did it flood? Did it flood? Who didn't flood? Who did flood? Who did? That made a difference. The longer the time limit is, now you rarely hear, you still hear a little bit, but you rarely hear people talk about, well, did it flood in 2016? Well, it's 2024 now. 8 years down the road. So my point is the longer we get away from those record-breaking 2.6, 3%, 4% interest rates, and we can level out in a range that is, I believe, say from 5.5 to maybe 7. Okay, if you can get some stability there for some long period of time, I believe it's going to make less and less of a decision relative to what you've got on an interest rate on the balance of whatever loan that you have on your property, assuming you do have a mortgage on your property.
Yes, I agree, 100%. Yeah, interesting topic you touched on the flood, right? So, that coincides a few years later with the major change in insurance. Like it's talking about inflation. One of the products that is getting hit hard by inflation is insurance, and that is affecting affordability, combined with the rise in interest rates. So it really has been challenging, and I've seen some pockets, some areas outside of Acadiana that are really being impacted by insurance.
Interesting that would be happening at the same time that there is ultimately a flight to those outlying areas in search of affordability. So what we've seen is that the amount of marketplace that sales outside of Lafayette, the space it's taking up has grown to now in 2023, I think it was 41% of all the sales that were reported to the Realtor Association of Acadiana were outside of Lafayette Parish. And when we talk in terms of new construction, a significant amount of new construction has moved into those outlying areas, and I find that interesting because there are areas in many cases where those areas are challenged because of the insurance scenario. So I presume that builders are building in very high areas of those particular parishes, and that again, insurance may be a challenge, but it's a challenge everywhere.
Right.
But clearly, we've seen in 2023 an increase in the amount of new construction outside of Lafayette Parish. Matter of fact, it increased 46% in 2023 over 2022. New construction sales outside of Lafayette Parish. They decreased in Lafayette Parish by about 15%, but increased outside of Lafayette Parish was 46%. To where now the percentage of new construction sales in Acadiana, 32% of them are outside of Lafayette Parish. Last year it was 21.5%. So we see that is a growth area, but as you point out, there are challenges to that growth, one of them being insurance.
Yeah, I guess as a developer, you need to find the land outside of Lafayette to find a little bit cheaper land, right? But also to not be too deep in the flood zone. So if you can find land that are high, like you mentioned, that will be the golden spot to move in and create a development, right?
And we're certainly seeing that happen, especially in the affordability range. Now, if you're in the upper range, you're in the 400 and above, Lafayette new construction is still, the preferred spot. But for the affordability aspects of it, there certainly is some allure, and it's all based on average sales price of a new construction outside Lafayette Parish versus inside Lafayette Parish. You've got a difference of probably somewhere around $50,000 to $60,000.
Yeah, that's good information. Joe?